Hi, and welcome to our course on how to make money from ETFs, or exchange traded funds. So what are ETFs and how do they work? So an ETF really is just a basket of stocks that somebody else has put together. Generally, they're put together by the large investment firms, Wall Street firms, BlackRock, these types of companies put together these ETFs where they do the research, they find the stocks, they do all the determining what they think are the best stocks to fit into a basket. And the basket could be based on geographical area, industry, a sector, a theme. It could be anything. There are thousands and thousands of ETFs for you to choose from. So essentially, somebody else has done all the work for you, and you just pick an ETF that you like and that is in an area that you're interested in. And the big advantage, I suppose, about ETFs, there's probably two main ones. One is they're low cost. They trade on an exchange just like any stock, so you can buy them on your broker account quite easily. You can buy them and sell them just like a stock. And they provide immediate diversification, so you can add much more interesting aspects to your portfolio. You can add commodities, you can add geographical diversification, you can add all sorts of different diversification to your portfolio, thereby reducing the risk within your portfolio. So ETFs are a very, very effective way of reducing risk, for spreading the load, and for making your portfolio a little more interesting and colourful. So what does UCITS mean and why is it important? You've probably seen this term UCITS on a number of ETFs and wondered what in the world is that. So UCITS stands for the Undertaking for Collective Investments in Transferable Securities, which is quite a mouthful, I know. But here's why it matters for you and in Ireland. UCITS is a European regulation that protects investors like us. So when an ETF is UCITS compliant, it means it's been vetted and must follow strict rules about what it can invest in and how much risk it can take on. So think of this as a sort of safety standard or regulation. So a UCITS ETF can't put all the money into one single dodgy company or sector. It also means that your investment get proper custody protection if something goes wrong with the fund provider. As an Irish investor, UCITS compliance is crucial because it aligns with Irish and EU financial regulations. So if you're looking at ETFs, always check the UCITS label. It's your assurance that you're investing in something properly regulated, not some Wild West fund hidden in a tax haven. So most major ETFs available to Irish investors are UCITS compliance, and you might find that your broker account will only present and display UCITS compliant ETFs. So when you see on CNBC them talking about the S&P ETF, that's not available to buy in Europe, but there is a UCITS version of that same ETF that's available, because UCITS aren't available in America. It's just a European regulation and a European requirement. So what are the advantages and disadvantages to ETFs, and what sort of things should you be watching out for? So ETFs aren't an answer to all your prayers, but there are some disadvantages. But let's first look at the advantages. So they are compelling, these advantages. One is that you get low costs, so often around 0.1% to 0.5% annually, compared to 1 to 2% if you were to put your money into a managed fund like Irish Life might provide, or some of the life or investment companies. You also get diversification with one purchase and flexibility to buy and sell whenever you want. You can build a global diversified portfolio with just a few hundred euros and a few clicks of the mouse. But there are pitfalls, and first is the sheer number of ETFs available. There are literally thousands of ETFs available in all kinds of sectors and themes and industries. And you can spend hours comparing when you should be investing. So second, there are something called tracking error, which is where the ETF doesn't perfectly match the index that it's following. And usually this is due to fees or rebalancing costs. And third, if you panic during market crashes and sell at the bottom, you lock in the losses. It's a bit like any stock, I suppose, from that point of view. But I have seen investors do this more times than I'd like. And finally, be wary of the overly complex or niche ETFs with tiny amounts of money in them. So you might find a niche that you're very interested in, but if nobody else is investing in it, it's going to be very illiquid and difficult for you to get out of that ETF if and when you want to sell it. There's also the tax, which is a disadvantage insofar as the tax that you pay is higher than if you were to purchase a stock. So where do you find all these great ETFs and figure out how to make loads of money from them? So there's one website that I find is very, very good. It's called justetf.com. It's a ETF screener website. There's quite a few other ones out there, but Just ETF does cover the UCITS European ETFs. The others are very American focused, which, as we've seen earlier, American ETFs, you won't be able to buy them in Europe. So you have to look for screeners that will cover UCITS ETFs. So justetf.com does exactly that. And it's genuinely one of the best tools for Irish investors. So when you land on the site, you'll see a search bar and filters that seem overwhelming at the time, but they're really just your friends to try and filter out and find the suitable ETFs. So start with these key filters first. So first you want to choose asset class. So you want to choose bonds or stocks or commodities, depending on what you want. Then you want to pick a region. So Europe, the US, emerging markets, wherever you want to focus and filter down that again. And then you want to, do you want a broad market? Do you want a sector specific? Do you want a theme like batteries or electric vehicles might be a theme? So you just have to figure out what it is that you're looking for in the first instance, and then use those filters to lower down and reduce the choice. Now, another very important thing to check when it does present a certain amount of ETFs for you is the expense ratio. And this is the fees that are associated with it. So anything under 0.5 is good, and anything under 0.3 would be really excellent. But then you also want to have a look at the amount of money that's involved in the ETF to see, is it a popular ETF? Not just is the chart rising and is it making a lot of money? Because if there's only a handful of people in it, well then it's going to be illiquid and you might be able to get into it, but you might not be able to get out of it when you want to. So look for one that's got a lot of assets invested in it, where the fees are low and within whatever sector you're looking for. So now that you've filtered through your ETFs, you want to start building a portfolio. So then the next thing to do is actually decide what sort of portfolio you want. So it's really, I suppose, even before you start on the filtering, you might want to decide on your philosophy first. So are you saving for retirement? Are you building wealth? Do you need income? Your answer will determine what your allocation is within the ETFs that you've chosen. So a classic starter approach would be what they call the 3-pillar approach, where this is 60% of your portfolio will be invested in global stock ETFs, 30% in regional, and ETFs are sectors. So you're getting a little more deeper into the whole thing. And then 10% would be in bonds or defensive, which might be gold or something like that. This gives you core stability within your growth potential. And some investors I know run an even simpler approach with just a global all-in-one ETF that would handle everything for them. Others blend ETFs with individual stocks. Maybe they might have 70% ETFs on as we've described, and 30% of their overall portfolio might be in individual stocks. But then in that situation, you've got to really know those particular stocks. You've got to have a good idea that these are the stocks you like and that there's value to be had in those stocks, and you can see where you have an idea of where you expect those stocks to go. So that will give you, between stocks and ETFs, that'll give you a very nice balanced portfolio. So as we've just mentioned, sometimes you might buy stocks, sometimes you might buy ETFs. And ETFs are very good in certain areas and stocks are very good in certain areas. So let's have a look now and see where we would be buying ETFs as opposed to stocks. So if you're looking for broad market exposure, for example, an ETF would be very good. So instead of buying each individual stock from the S&P 500, where you'd have to do 500 purchases, you can buy one ETF that covers the entire S&P 500, and that gives you a very broad exposure to the whole US market. Also, if you want a geographical spread, so if you want to invest in Asian markets or emerging markets, then our commodities, then an ETF is definitely the way to go, because you can pick an industry, a sector, a theme, a geographical area, and you can invest in that. So, for example, you could invest in Chinese EV development, and you could get a whole area of lithium, electric vehicle companies, battery makers, all in the one basket. If you think that is, where it's at and where you want to put your investment. Now, stocks on the other hand, such as Apple, Microsoft, LVMH, for example, these sort of companies, they dominate the area they're in. They're always going to be good. They're always going to keep going. They're solid, well-managed companies, and to buy into them individually would be very worthwhile. Because while they might be overvalued from time to time, in general, they will continue to grow. They're money-making machines. They've cornered the market where they are, and they're solid, good investments. So a mix of, depending on what you want, where you want to go, that's how you would mix between stocks and ETFs. And now we come to the most critical and perhaps most confusing part of investing in ETFs in Ireland, which is the tax treatment. And this is different from individual stocks. Most ETFs are subject to what is called exit tax at a flat rate of 38% on both gains and income. This is higher than the 33% capital gains tax on individual shares. But the biggest difference is the 8-year deemed disposal rule. And under this rule, every 8 years revenue treats you as if you have sold your ETF, even if you haven't. You must pay the 38% exit tax on any unrealized gain. And this means that you have to have cash set aside to pay that tax liability, which is why it's so important to be aware of this rule. But the government has committed to aligning Ireland's tax treatment of funds with that of other EU countries, which would most likely bring the 38% tax rate lower towards the 33% CGT rate. And also it is hoped that it would scrap the deemed disposal rule. So here I've put together 3 portfolios just to give an idea of 3 different portfolios using ETFs. So these are all 100% ETF portfolios. And the first one is based on a theme of clean energy and electric vehicles. And it sort of captures the structural shift towards electric mobility and renewable energy. So you're not betting on a few hot stocks here. You're riding the mega trend that governments worldwide are enforcing through regulation and subsidies. So the battery and lithium exposure hedges EV manufacturers' volatility by capturing the supply chain. And the CLNE ETF provides your stability base. The E-car gives you the growth narrative of Tesla, competitors and charging infrastructures, and the LITH ETF captures the resource opportunity. The INRG adds exposure to emerging clean tech, and they're all used to compliance. They're all euro denominated, meaning there's no dollar exposure, foreign currency exposure, and you get all the full regulatory protection. So the next one is the next one bets on non-US tech leading companies. So if you consider that all the US tech companies are overvalued and you don't want to go there, well then there's non-US tech companies that you can look at. So these would be European tech companies, emerging market tech companies, Asia Pacific tech companies. And there's lots more in the world than just Apple and Nvidia and these kind of stocks. So there's plenty to be found outside of the US, and this is an ETF that is again euro denominated, UCITS compliant, but looks at tech outside of the US. And finally, then we have an emerging markets portfolio based on ETFs. So this is your bet on long-term global wealth redistribution. So if you think that the US is sort of fading a bit with all the Trump tariffs and all that sort of stuff, and other companies like the BRICS countries, China, Asia, India are all resurging, well then this maybe is the one for you. Now this is a long-term bet with a much longer time horizon. But one to consider maybe, or even pick between all 3 of those, or do your own research, go to just ETFs and pick out stuff that you like. So now that's a quick overview of ETFs. and how you can add them into your portfolio and really make your portfolio a lot more interesting and innovative, looking at different kinds of investments, commodities, emerging markets, and more in areas that are more difficult to access through a normal broker account buying stocks. Like, it's very difficult to buy Chinese stocks directly, but you could use an ETF if you wanted to buy them. So an interesting approach to add something new and invigorating into your portfolio. So the best of luck with that.